When everything sells off, what cross-asset volatility is telling us about sovereign debt? The simplest explanation is often the most accurate. Over the past several months, markets have delivered a rare and telling signal. Sharp run-ups followed by violent reversals across multiple, very different asset classes. Bitcoin experienced a drawdown of roughly 40% or more from its late 2025 peak during the recent sell-off. Precious metals, typically seen as safe havens, surged aggressively before reversing, with gold falling around 10% in a single session and silver suffering even steeper declines amid heightened volatility. United States equities, after a powerful rally that briefly pushed the S&P 500 above 7,000 for the first time in late January 2026, have since pulled back, with certain sectors losing enormous market value in a matter of days. These are not isolated events. When assets with different use cases, risk profiles, and investor bases begin moving together, up violently, then down violently, it points to a system-level force, not asset-specific fundamentals. This is cross-asset volatility, and it carries a message. Section 1. One pattern, not three markets. What we are seeing is the same behavioral pattern repeated across crypto, metals, and equities. Crowded positioning, followed by leverage, followed by a volatility spike, followed by forced deleveraging, followed by rapid sell-offs. Different assets, same movie. Historically, periods of economic uncertainty triggered a familiar response. Capital fled risk assets and flowed into long-term government bonds, pushing bond prices up and yields down. That mechanism helped governments refinance existing debt and issue new debt at manageable costs. This time, that reflex is weakening. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 2. The repricing of sovereign risk. Many advanced economies are now facing a structural problem: high and persistent budget deficits, higher for longer interest rates, rising yields and falling prices in long-duration government bonds, growing skepticism about long-term debt sustainability. Instead of acting as unquestioned safe havens, some sovereign bond markets are behaving like stress indicators. We can see this tension across major economies. Japan, where long-dated government bond yields have surged amid fiscal and political concerns. The United Kingdom, where borrowing costs have risen alongside fiscal uncertainty. France and parts of Southern Europe, where deficit paths and political instability continue to weigh on bond markets. At the same time, central banks have been persistently accumulating gold, with global official sector purchases remaining historically elevated through 2025. While not at absolute record levels, this sustained demand signals a clear preference for a politically neutral, non-default monetary asset over long-duration sovereign promises. Gold's role here is critical. It is not a growth asset, and it does not generate yield. Its appeal rises precisely when confidence in the long-term solvency of debt issuers begins to erode. Section 3. Why everything is moving together. As confidence in long-term government debt weakens, the system enters a feedback loop. If the marginal buyer of long-duration sovereign debt steps back, yields rise. Rising yields increase refinancing costs for governments. Higher government borrowing absorbs more capital, crowding out productive private investment. Liquidity is pulled from risk assets and alternative stores of value alike, producing synchronized volatility. This is why we are seeing stress across crypto, equities, and even traditional safe havens. It is not panic. It is repricing. Markets are no longer assuming that sovereign debt is automatically risk-free. Section 4. What this signals. This does not mean a sovereign debt crisis must occur tomorrow or on a specific date, but it does mean the probability of fiscal stress, policy constraint, and structural adjustment is rising. Cross-asset sell-offs are not random noise. They are signals. And the signal today is clear. The global financial system is quietly reassessing the sustainability of sovereign debt. In a world where long-term government bonds no longer command an automatic bid, difficult choices eventually follow on deficits, spending priorities, and the true cost of borrowing. When everything sells off at once, the market is telling us something fundamental has changed.